Okay. So today we're diving deep into the Indian stock market, early April 2025. And we've got this weekly newsletter, Volatility Coaches of India, April 6th, 2025.
Yeah.
And alongside some figures from March 30th.
Right.
So really, we're trying to get to the core of what this newsletter is telling us about, volatility in the Indian market.
Yeah, exactly. I mean,
Right.
we're looking at hard numbers,
Right.
some expert commentary, all kind of, centered around this idea of volatility.
Right.
And if we look at these 2 weeks of data and then, bring in this newsletter's broader perspective,
Yeah.
I think we can really understand what's going on, for anybody who's following the Indian market.
Right. So let's start with these RVCC parameters.
Yeah.
So we've got them side by side,
Yeah.
March 30th to April 6th. And first up, the PE ratio, which went from 21.39 down to 20.8.
Okay.
So
Yeah.
the PE ratio, if you're not familiar, this is a key valuation metric.
Right.
You're looking at how much investors are willing to pay for each rupee of a company's earnings.
Yeah.
So lower PE, a lot of times means that the market's getting a little bit less expensive.
Yeah, so that's telling us that relative to the profits that the companies in the index are generating, those stocks were trading at a slightly lower premium,
Right.
On April 6th compared to the week before.
Okay. And then, the price to book ratio, we see a similar move, went from 3.55 down to 3.39. And this is another way to look at value, right?
Yep.
You're comparing a company's market value to the net value of their assets.
Exactly.
So again, kind of a slight downward trend there.
And that aligns with what we saw in the PE as well.
Right.
It just suggests that, over that 1 week period, there was just a general, cooling off in terms of those fundamental valuation metrics.
Okay, market cap to GDP. So now we're looking at, big picture stuff.
Right.
The total value of all the listed companies compared to the overall economic output
Exactly.
of India.
Yeah.
And that went down as well, from 116.33% down to 113.25%.
Yeah.
So what does that kind of shift usually tell us?
So, a lower market cap to GDP can be seen in a couple of ways.
Okay.
It might indicate that overall the market valuation is becoming more reasonable relative to, the size of the economy.
Right.
Or it could reflect kind of a broader, market correction
Mm-hmm.
where asset prices are adjusting downwards.
Okay. And now here's where I think things get really interesting.
Okay.
RSI, the relative strength index, jumped up from 50.2 all the way to 65.
Wow.
So for anyone who follows, momentum, RSI is a good tool to tell you if something's overbought or oversold.
Right.
And generally above 70,
Yeah.
you're thinking, oh, okay, this is
Repeated.
maybe a little bit too hot.
Yeah.
So 65, big increase in buying pressure,
Yeah.
moving towards that overbought zone.
Right.
Does the newsletter say anything about why this buying pressure suddenly emerged, or is this more like a technical move?
Yeah, it's a great question. And the newsletter doesn't really delve into, the specific reasons for that sudden surge.
Right.
So it seems like it's more of a technical observation based on the price movements,
Okay.
suggesting that momentum is building in the short term.
Okay. FII net open interest change went even more negative.
Oh.
From negative 9,806 to negative 19,807.
Oh, wow.
So negative here, means that foreign investors have got more bets that the market's going to go down than bets that it's going to go up.
Exactly.
And that negative number got way bigger, almost doubled.
Right.
What's the story there?
Well, that's a strong indication of growing bearish sentiment,
Right.
among these major foreign investors.
Yeah.
So, they've not only maintained a negative outlook, but they've actually increased their short positions, which suggests that they have a greater expectation for the market to decline.
And we see that reflected in the Nifty itself, which went from 23,519.35
Okay.
all the way down to 22,924. So that's a huge drop.
Yeah.
Over 600 points
Wow.
in just a week.
Yeah, that's a pretty significant decrease, and I think it underscores
Right.
this shift in sentiment that we're seeing across all these indicators.
Okay, the Nifty 13 EMA, that's the 13-day exponential moving average.
Right.
Kind of your quick temperature check
Exactly.
on the direction of the market.
Yeah.
That also decreased from 23,208 to 2,378.87. So, slight downward shift there.
So it's a small change, but the direction does corroborate
Yeah.
that broader downward movement that we're seeing in the Nifty Y.
Yeah.
And that, that increasing bearish positioning by the FIIs.
Okay. And then finally, the India VIX. So this is our measure of expected market volatility.
Right, the fear gauge.
Yeah, the fear gauge, exactly. It went up from 12.72 to 13.76.
Okay.
Higher VIX generally means, more anxiety, people expecting bigger price swings.
Right.
So it looks like the market is bracing for more ups and downs.
Correct. And the rise in VIX, often accompanies market corrections or, periods of uncertainty. And it indicates that investors are, expecting larger price fluctuations in the near term.
Right. Okay. So that was our deep dive
Yeah.
into the RVCC parameter.
The week-over-week changes.
Right.
Pretty interesting.
Yeah. Okay. So the newsletter also talks about the Buffett indicator.
Right.
So let's switch gears and talk more long term.
Yeah.
What is that telling us about the Indian market?
So the original Buffett indicator, which compares total market capitalization to GDP, provides an expected annual return for the Indian stock market of 6.7%.
Okay.
And that's based on expected economic growth of 6.86%.
Okay.
A dividend yield of 1.55%.
Okay.
And a valuation reversion to the mean of negative 1.76%.
Got it. And then what about the modified version?
So the modified model keeps those, economic growth and dividend yield projections the same, but the valuation reversion to the mean changes ever so slightly to negative 1.77%.
Okay.
And as a result, the expected annual return under the modified Buffett indicator is 6.6%.
So even though we just saw that we're short-term...
Yeah, the downward movement.
Downward movement in the RVCC parameters.
Right.
Both of these versions of the Buffett indicator are still, pointing towards moderate positive returns.
Right.
Over the long haul based on these fundamental valuation principles.
Exactly. And I think, that raises the question for anyone listening.
Right.
How do you reconcile that with these immediate bearish signals,
right,
that we're seeing?
Yeah. Is this a buy the dip moment, or
Right.
is this, batten down the hatches?
Right. Or is it, too early to say?
Yeah, exactly.
That's the million-dollar question.
Okay. So the newsletter also has some specific observations and conclusions based on these parameters. And, they highlight a key Nifty Y level, they say. Below 22,000 Nifty levels, buy more equity in staggered manner and include multi-asset strategy. So that's pretty direct guidance.
Yeah, it is quite direct. And, it suggests that the newsletter views the 22,000 level on a Nifty Y as, a potentially attractive entry point for investors.
Okay.
And they're recommending a gradual investment approach and diversification, across different types of assets to manage risk.
They also say to convert to multi-cap funds if the market goes lower.
Interesting.
What's the thinking there?
Well, multi-cap funds, as the name suggests, they invest across companies of all sizes.
Right.
Large, mid, and small.
Yeah.
So, in a declining market, that diversification can potentially offer a little bit more stability than, funds that just focus on one, market cap segment.
Right.
And it allows investors to, benefit from opportunities across, the whole market spectrum as valuations become, more appealing.
Got it. Okay. The newsletter also says to focus on large cap funds and hybrid funds. So why is that?
So large cap funds, which invest in those, well-established larger companies, are often perceived as being, relatively more stable during times of, market uncertainty.
Yeah.
And hybrid funds, which, strategically allocate investments between equities and debt, they're aiming to provide a balance between, growth potential and risk management.
Right.
So that could be a prudent approach in
Yeah.
this current environment, with the increased, anticipated volatility.
Okay. And sector-wise, they like banking, finance, and the pharma. So any thoughts on that?
So these sectors are often considered, fundamental pillars of the Indian economy.
Right.
Banking and finance, obviously essential for, economic growth and activity.
Yeah.
And the pharmaceutical sector is generally seen as, quite resilient.
Right.
And can even benefit from certain economic conditions.
Right.
So this suggests a tilt towards sectors, with potentially stable or growing demand.
Okay, now let's take a step back and look at the historical perspective that this newsletter gives us.
Right.
They give us a list of Nifty Y levels and, their associated trend indicators going all the way back to January 2022. So, you see how these things, have historically lined up with actual market movements.
Right.
Of course, it's not a perfect predictor.
No crystal ball.
But it can give us an idea of, what these signals might mean.
Absolutely.
Yeah.
I think that historical overview is really valuable
Yeah.
for, understanding kind of the ebb and flow of, market sentiment.
Yeah.
We see various periods identified as, negative trend, positive trend, neutral.
Right.
Even specific, zones labeled as, investing region.
Yeah.
Very negative
Yeah.
at different, FFTY levels.
Right. So, for example, they point out a negative trend around 17,617 back in January 2022.
Okay.
Then positive around 17,287 in March of that year.
Okay.
And then, more sustained positive trends starting in mid-2022, extending into August.
And then a period of more cautious sentiment,
Right.
With the neutral to negative outlook in, late August 2022.
Right.
Which then led into that, investing region, followed by a very negative, in September 2022.
Yeah. Right.
So it shows how quickly, perceptions can change.
Right. Then we see a positive close above the 13 EMA in October 2022. They said that was a buying opportunity.
Okay.
Then they said gradually book profits in November.
Okay.
And then, towards the end of 2022, those negative signals reemerged, continued into early 2023.
Yeah, it's fascinating to see those, specific calls aligned with, those NFTY levels.
Yeah.
And that 13-day exponential moving average
Right.
really demonstrates, their consistent methodology
Yeah.
in assessing market trends.
Right. Okay. And then in April 2023, back to a positive outlook for equities, the negative again, August 2023.
Okay.
But then from November 2023, the trend went back to positive. And it kind of stayed that way for a while. But then they point out a negative trend starting in December 2024.
Right.
Reversal back to positive in March 2025.
Okay.
And then they end this whole historical analysis by saying that, after a positive close the previous week, the NFTY closed negative as of April 4th, 2025. Right.
So short-term bearish trend.
Yeah, signaling a bearish short-term trend.
Right, so a lot of shifts and changes.
Yeah.
And most recently, bearish in the short term.
Right.
After a little bit of a positive move.
Exactly.
Okay, sectoral index performance as of April 6th, 2025.
Okay.
We got a table here covering lots of different market segments.
Yeah, this gives us a snapshot of how different parts of the market performed on that day.
Right.
And we can see, negative percentage changes across the board for almost, all the indices listed.
Yeah, so we're looking at, the Nifty 100, Nifty 200, the broader Nifty 500,
right,
all down for the day.
Yeah.
Mid-caps, Nifty, mid-cap 50, 100, and 150, also negative. Small caps, even more negative.
Yeah, it looks like, the Nifty small cap 150 and 200 is showing even, more significant negative percentage changes
right,
for that trading day.
Okay, and then for some of these, like the Nifty 100, the mid-cap 100, Nifty small cap 100, we also have the PE ratio, price to book ratio, and dividend yield.
Yeah. Anything that jumps out at you there?
Yeah, one thing that, really stands out is that significantly higher PE ratio of the Nifty mid-cap 50.
Okay.
Which stands at 38.35.
Wow.
Compared to the Nifty 100, which has a PE of 20.84.
Right.
So that suggests that on average, mid-cap companies within that index, we're being valued at a much higher multiple of their earnings than those, larger, more established companies, the Nifty 100.
Okay. And then even though we see all these negative changes across the board on April 6th in this table, the newsletter also says that Nifty Small Cap 100 remains positive and Nifty Mid Cap 150 also remains positive.
Interesting.
So how do we make sense of that?
Yeah, so that's a really important distinction.
Yeah.
While the sectoral index table is reflecting performance, on that single day, April 6th,
right,
those separate statements in the newsletter, they're likely referring to the overall trend or performance over a longer time frame. Perhaps looking at, the week or month leading up to the newsletter's publication.
Right.
So while, that particular day saw declines across the board, the broader trend for small and mid-cap indices might still have been, positive up to that point.
Right.
So it just underscores, the importance of considering both, short-term fluctuations and the bigger picture trends when you're analyzing, market movements.
Right. So it's not just about, one day's worth of data.
Exactly.
It's about the overall trend.
Right.
Okay. So to sum up, our deep dive into this newsletter, we've seen a market that's, recently gone down.
Yeah.
Short term across most major indices.
Right.
Leading up to April 6th. Right. Increased volatility expected.
Yeah.
And foreign investors, becoming more cautious, maybe even bearish.
Right.
But the long-term valuation models, like the Buffett indicator, are still suggesting, that there could be moderate positive returns in the Indian market in the years to come.
Yeah.
And the newsletter itself says, buy more equity gradually if the Nifty Y goes below 22,000.
Right.
And right now, they like large cap and hybrid funds.
Right.
But they also say that, small and mid-cap indices
Yeah.
are still looking positive over a longer time frame.
Yeah. So it's really interesting,
Yeah.
this interplay between those, short-term bearish signals
Right.
and, a potentially more optimistic longer-term outlook,
Right.
particularly in certain segments like small and mid caps
Yeah.
over a wider period.
Yeah.
It presents, some real food for thought for investors.
Like, what are you going to do?
Exactly. How are you going to, weigh these different signals as you, think about your investment approach?
Right.
What importance are you going to give to, short-term volatility compared to long-term valuation models?
Yeah.
And how might you react, if the Nifty Y does approach, those 22,000 levels?
Yeah.
Mentioned in the newsletters, buying advice.
Yeah.
These are some, really important questions to think about as you navigate the Indian equity market.
Absolutely.
Yeah.
Lots to consider.
Lots to consider.
Always.
As always.
Okay, well, thanks for joining me on this deep dive.
Thanks for having me. It was a pleasure.
It was great to have you, and we'll catch you on the next one.
Sounds good.